coming to you on Thursday morning, January 10th, about an hour before the open. The market again crept higher on Wednesday, but with a lack of momentum, and it's facing lots of scale-up shorting as the S&P reaches major resistance between 2580 2620. Yesterday, the index got to 2595, splitting the difference, but satisfying the minimum minimum requirement for this advance. There are several reasons why we have projecting this resistance. Let's recap. 2888 is the closing weekly low. We'll go to the weeklies in a second, but 2888 is the closing weekly low from the first quarter plunge. It's a weekly closing low that lasted until the week of December 17th. So it lasted from March all the way through December 17th. And when that December 17th low broke, when the when the first quarter low broke, I should say, on the week of December 17th, it caused a selling panic. However, you'll notice that the S&P found low 1 week later as it satisfied a 50% retrace of the entire 2016 to 2018 range. The midpoint, the 50% retrace of that bull market leg, is 2375-ish, and the index undercut it nominally for 1 day, going to 2346. So this geometry is one example that underpins the strength of why I adhere to W.D. Gann's geometric methods and why I key off the weekly swing chart. As W.D. Gann said, no matter what time frame you're trading on, key off the weeklies. So you've got this 2888, which was tagged yesterday. That's an important level in the market as a memory. And you've got this 2620 level, that 2620 region, which is the neckline of last year's big head and shoulders top formation. I'm going to go to the weeklies, but I want to keep this hourly S&P on the screen for a reason, to expand it enough to see the trend lines. After snapping the 2620 level, that's the neckline of for the head and shoulders pattern, topping pattern for 2018, it's common for an item to rebound, to bungee, to back test and kiss the neckline. We're in the wheelhouse of that region now at around 2620. We're in the lower end of that region. This hourly S&P from showing the all-time high back in September, from the low for the move on December 24th, it shows that yesterday tagged the upper rail of this trend line. This is a channel here that ties these lows and this high. I paralleled off this line, and we tagged that yesterday. Also, because the index closed below the first hour opening range, it suggests an entire day of distribution and selling. I suspect a big fund started a buying campaign on the first trading day of the year and was finishing up tag ends yesterday. The big Wall Street firms know when he's finished and go short. You know this is playing out when you see an entire day of backing and filling and then a gap down. That's what it looks like where we are now. So the hourlies look like a setup is on the table for a possible drop in the next week's monthly option expiration, with a drop down to the trend line connecting the December 24th low right here and the January 3rd low. So that pulls you back to around 2520. And it also ties to the 50 hour. You see this blue line, this is a 50 hour moving average. So right in here at this level going into the expiration, you've got the lower rail of this very short term hourly channel, trend channel, aligning with the 50-hour moving average right at around 2520. And you'll notice that 2520 is also the high of the first leg up. So we'll talk about that in a second. While a picture perfect measured move of this 174 point first leg up ties to 2618. So here you have a 174 point move, possible A wave up, A leg up, a pullback, this B here for a B wave decline, bullish decline, corrective bullish decline, and then a C wave up. This would be perfectly symmetrical at 2618. However, if that level is reached, I think it comes after a 2 to 3 day pullback, which again could be as deep as 2520. Before then, a lift back to the 2618 to even as high as 2644. What's 2644? That's 50% of the entire bear market decline. So these, as I mentioned before, these, if you're not paying attention to these, it may sound a little inane, a little simplistic, but I assure you that the market is geometric, and these 50% retraces are important. It worked out on the 2016 to 2018 advance into December 24th. That was a 50%, big 50% retrace of that whole advance. And there's no reason to think that ultimately we don't get to 2644-ish, which is a 50% retrace of the entire leg down from September to December. Also, keep in mind, again, had a way of analyzing the year based on geometric divisions of the circle, the 90, 180, 270 day, 360 day cycles. And of course, the December 24th low is roughly 90 days from the all-time September 21st high. So a low was due sometime in that vicinity. So let's pull back the lens a little, and you can see now this ABC 174 point leg pullback and another 174 point leg ties to this 2620 level, and you can see this region down here at 2520 ties to a back test of the high of the first leg up. So pretty symmetrical. That's if it's a picture perfect measured move in play, where the recent up leg is symmetrical to the first leg. However, the market isn't a Swiss train conductor, and the rally could end at any time. If the market was as simple as connecting the dots all the time, we could all phone in our trades from our yachts. But there are often many detours, and trading picture perfect idealized setups, there's often a monkey wrench, and it's like trying to catch a snake by the ears. So why I think that we get this pullback first is because we tagged a rising trend line connecting the hourlies right here and down from this high. So there's a convergence right here, and I think it was probably an option setup or an ARB setup into option expiration. So I think that we get a pullback here first, probably to the 2520 level, and then if we rally, if higher targets are in play, and then we rally up to 2620 or 2640-ish, then I think you can get possibly a sharper plunge, especially if 2520 is broken. Why? Because there's an open gap here around 2460, 2470-ish. So that could be a 90 point decline if you break 2520. This level here sets up, if you should ever get back into there, sets up a a nice risk to reward buying opportunity. So this is the problem with bear market rallies. They are sharp and violent short squeezes, but once they run their course, the market can collapse all the way back down to the lows. Um, you've got to have a strategy of knowing when to get out. One of the best tells for knowing when to get out is watching the behavior of the glamours and leaders. Yesterday, two of my favorite names are Twilio and MDB, and despite yesterday's rally, MDB was down like 4 points, I think five at the lows of the day. Twilio was pretty much down all day, and today MDB is down 11 points. So that's the sign that that if a big fund indeed was putting on a buying campaign, that um, they had finished or were finishing up yesterday, and the big Wall Street firms know this. They see when the account's done. They put on shorts, and then you get your gap down. So if you've got nice profits from the rally, this is a place to take some of them off the table and watch and see what happens after a potential 2 day pullback, another 2 day rally perhaps, and then a sharper decline, probably into option expiration. Otherwise, we probably go right up into next Friday's option expiration after a pullback, tagging these potentially higher levels. Good luck out there today. I'll be back and speak to you later.